Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back again for another edition of That's Our Two Satoshis Live. This time, joined by someone probably most of you know, Hal Press, joining us from, I can only imagine, somewhere above the Pacific Ocean based on your background here. But Hal Press from North Rock Digital does a lot of great work in the digital asset space, talking about tokens and tokenomics, and happy to have you aboard here. How are you, sir?
I'm doing well. I'm doing well. I'm actually in New York, but my background is a picture of North Rock, which is the
Ah,
fund's namesake.
well, that makes a lot more sense than my random guess of the Pacific Ocean.
No
Anyway,
worries.
before we get started here, as always, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. But for those new to the show, we've been writing a weekly blog for 5 years now called That's Our Two Satoshis. You can get on our website at ar.ca/blog. And we'd like to talk about what's going on in the digital asset market. So, to start with, Hal, what I was first, before I get into dYdX and tokenomics and unlocks, kind of just looking at the broader market structure for a minute here as we close the books on January. Pretty big month, call it on average up 40%. Obviously, a lot of tokens up quite a bit more than that. In my opinion, going back to probably middle of December, it seemed kind of obvious to me at the time that the bottom was in. I didn't really see any signs of what would make us go higher, though. And what I mean by the bottom is, look, shorting became structurally very difficult with with FTX gone and Genesis gone and all these other areas where you could get leverage. So it felt like there was going to be less shorting. You had macro starting to shift, everything from peak rates to the VIX approaching the lows, the dollar approaching the lows, as well as just in general, you had peak fear around FTX and the collapse there. So again, in my opinion, there were a lot of bottom signals, but I just didn't know what the catalyst was going to be for the rally. I know you felt similarly. Did you see anything that would have indicated the kind of a start we had to the year here?
Yeah, I, I did expect a sort of sharp New Year's mean reversion rally. I'm not sure I expected 40% in January, but I did expect some sort of rally. And I have been somewhat vocal about my thesis for why. And the gist of it was basically a lot of what you mentioned. I think generally just after the FTX event and then going into year end, I think there was really three structural sort of technical forces of selling that all coincided with that year end date. You had fund redemptions, which were obviously quite excessive after all the blowups of the year, and a lot of funds had annual redemption cycles. You had fund window dressing. Basically, no traditional finance funds wanted to show any exposure to crypto after what had happened to end the year, and they had to obviously file their 13Fs um, at the end of the year, and so they wiped all exposure into that date. And then also tax loss selling, which you just have often. And there weren't a ton of gains, but there were some large VC funds still had gains during the year and wanted to sell things to monetize, to offset those gains. And so you had those three forces. And then on top of that, I think you had, like you said, a lot of bottom signals where basically everybody that was going to sell crypto or every excuse possible to sell crypto you had. And so if you were holding crypto after that on D's 31st and after all those technical forces, you were basically an extremely strong hand. And there was really nothing that was going to make you sell at that point. And so I agree, the obvious sort of upside catalyst wasn't there, but just knowing this space, like when you have such intense selling exhaustion, it doesn't take much. And I think the thing that's hard to remember in the moment when things are down only like that is just if there's one thing this space is good at, it's creating FOMO. So
Yeah.
if you have even like a small uptick and you know that all the discretionary pockets of exposure, like retail, fund exposure, everything, those all have basically been zeroed. And as soon as they start to trickle back in, knowing that there's such hardened supply, it will create a rally. Like that's kind of a given. And then if you take the next step on that, like you said, um, I agree with you that structurally there was difficulty in shorting, but there was still this consensus that like you have to short alts because alts are just dead in their structural supply. And honestly, I was guilty of it myself. As I had said on Twitter, like I was short Aptos to start the year, and I think there was a lot of people that were short a variety of things. And the next step in that sort of thesis is just that once you had that little uptick, you were going to get these nasty short squeezes, and all the short exposure was going to get wiped out. And so that I did kind of see that coming, and I did sort of predict that. What I didn't see is the sort of magnitude of it. And I didn't think we'd get such a extreme sort of alt season and animal spirits so early in the year.
Yeah, and some of that is just math, right? I mean, people forget if something falls 90% and then it
Right.
rallies 100%, it's still down 80%. And some of these big moves from the bottom, if you just look at a 1-year chart, it still looks pretty horrific. But if you look at a 30-day chart, it looks amazing. And to your point about the window dressing, I mean, obviously that goes well beyond just the tokens themselves. I mean, you could look at Coinbase stock, you can look at Grayscale, GBTC, and ETH. I mean, anybody from the traditional finance world who was holding a somewhat meaningless position of crypto relative to maybe their core strategy, they were getting out at all costs. And a lot of that retraced pretty hard once we turned in the new year. I think with regard to the rally, though, what I was trying to think through, though, is when you look back at some of the bigger, long-lasting rallies, from 2017, which was sparked by ICOs, and the spring of 2019, which was really sparked by when Facebook announced the now mothballed stablecoin project, or March 2020, sparked by COVID and the money printing, or even 2021, which was sparked by DeFi and stablecoin and NFT growth. Even last year, right? Even amidst a horrible year, you had the Ethereum 2.0, rally in the third quarter. I think the difficulty right now is that I don't know what to name this one, right? This one was just called the lack of fraud and bankruptcies, or what?
Yeah, I'd say there's two things that are probably a little underappreciated. One, I don't think people talk about much, is just that there was a large expectation that Mt. Gox was going to be distributed in March, and that got pushed to September, really, July or September. And I think there was a lot of people that had been apprehensive about putting on exposure because of that. And so that was part of it. And that extension really happened at the very beginning of the year. And so that was actually somewhat of a bullish catalyst. And then the other thing I think is just that there was a real macro inflection. Like if you look at the 10-year, it's 50 bips off the highs, right? The S&P's 15% off the lows. Like we're within 50 bips probably of terminal rates. A lot of growth stocks have repriced. Like there was a real macro inflection, similar to what happened with the COVID inflection.
Yeah, but I think I think that macro inflection started more. Like if you look at
it did, right? But then FTX. So if you remember, like right before FTX, crypto actually rallied a lot. Like we went 20% off the lows, right, as we priced in the macro inflection, and then FTX just crushed it. And so I think it was really just that macro inflection coming back for a second time, and you repricing that, like, well, hold on a second, FTX actually didn't kill this industry.
And if you don't have to be a technical analyst to draw on a chart. If you just look at some of the price charts from, like, call it mid-September to November 4th, and then you just ignore what happened post FTX and into year end, and then look at where it is today, you basically are kind of going on a straight line, right? A lot of these gains have been retracing that. So
I agree.
So with that, let's move on to the next topic. One of the tokens that has really retraced, and one of the ones you've been vocal about and I've been vocal about, has been dYdX. And I think it's interesting because both of us are long the token. You're explicitly long, and everyone knows it. I think some people think that maybe we were short, given how harsh we were. And I would encourage everybody to look at maybe what I wrote on Twitter at jdorman81, or what Hal has written at NorthrockLP. But essentially came at it from two different angles here, which is that dYdX, the business, is in really good shape, right? This is the #1 decentralized derivatives platform. 70 to 80% market share, depending on the week or the month that you're looking at the data. Clearly a good UI, clearly a good product. The token, however, clearly doesn't have a whole lot of ties to the project itself. And I think, when we talk about investing, right, there's a couple of things that matter in investing, right? One is identifying the theme or the idea, and two is the best way to express that idea. And I think, most investors, ourselves included, would look at dYdX, the business, and say, this is something that you want to invest in. But the difference between tokens and maybe, other investable instruments is that usually there's a more explicit tie between the business and the equity, or the business and the bond, right? There's plenty of examples in the corporate debt world and in the equity world where, you might have, let's say the corporate bond world, right? There's plenty of examples where you might have a good company, but a bad bond, right? That bond is subordinated, or maybe it doesn't have very strong covenants. And you might have the other way around, right? You might have a terrible company, but a good bond because it's senior secured, it has great covenants. But in the equity world, it's pretty straightforward. If you have a good company, you probably have a good stock. If you have a bad company, maybe you have a bad stock. The tokens are much you have a lot bigger of a bifurcation or dichotomy, where you could have great business and terrible token, right? And you could have terrible business but really good token. And I think dYdX is in that former camp, where I think we all agree, great business, a lot of good things going for it, but the token has a lot of problems, and one of the main ones that we pointed out recently was that dYdX Trading, the company behind dYdX, the protocol, basically takes 100% of the revenue, while dYdX, the token, gets hit with all of the inflationary rewards of the token. And as a result, you have a scenario here where the growth of the business is not aligned with the community and the token holders. So we set out to kind of point some of these incongruencies out and talk about why this is such an issue. And at the same time, we pointed out the lack of transparency around their revenues, some of the things that maybe they could do better to be more token holder friendly. And I'm not going to attribute the gains of the last few weeks to us, but I think it probably was a small contributing factor, which is the dYdX Foundation is at least starting to be a little more transparent, a little more proactive about some of the things they're putting out. So I'll kick it over to you. What did you see in dYdX when you went long? I think this is another one that maybe you reversed on, that you were negative and then went positive on. What did you see? Did you dismiss some of the negative things that we pointed out, or do you just see those as being catalysts for future possibilities? What's your kind of thesis here on dYdX?
Yeah, sure. And you're right. We actually first, started looking at this from the short side, and we did short it. We actually made a lot of money shorting it last year, because I think there was this extremely large cliff unlock that the market was quite worried about, and ourselves included. When you looked at it, it was very it was a lot of supply coming to market, and at the time there hadn't been a lot of vocal communication from the team about trying to fix the tokenomics. So when you looked at it, it looked a lot like you said, like a good business. The leader in this space. However, the volumes had also been coming down, and the token not getting any of the value, and this massive unlock coming, and it was just this idea of like, we're in a bear market. Where is the demand going to come from to buy all this supply? However, I think things pretty dramatically sort of reversed over the course of January. From a fundamentals perspective, the trading revenue picked up quite rapidly, and I think that happens partially just because the market rebounds. But now, dYdX is doing about $10 million of monthly revenue, and they're only emitting $7 million in token issuance. So for the first time, basically ever, they are actually net income positive from just an overall protocol standpoint. So that was sort of the first factor that we monitor.
I would caution in there, though, that the 10 million of revenue goes to dYdX.
Right. That's what I said, from a protocol level.
Yeah, sure.
And then, and then the second piece of it was, obviously, we only really flipped when the unlock got pushed, and the team came out and said it was going to be pushed. And that was kind of the inflection point for us, where we said, all right. And then the third point was, as we've been following it closely for this, we'd started to see that the team had been pretty clear and pretty adamant that with V4, the tokenomics were going to be dramatically sort of overhauled. And that gave us really high conviction confidence that with V4, all revenues were going to start flowing to the token holders. And the mechanism via which this is going to happen is they're essentially obviously going to launch their own chain. The dYdX token will be an L1 token, and you will stake the token and receive revenues just like you do, staking ETH, and you get the ETH fees. And so that like, you had kind of three different factors all positively inflect at the same time, and that created a really strong confidence for us, where you had the fundamentals inflect, the unlock inflect, and the tokenomics inflect, where this was a token that really was hated, but the consensus view on it was to dislike it. Like, everyone sort of agreed that this was not a good tokenomics project. And so what that meant is that despite the fact that people liked the project, no one really owned it. And so I think, being a smaller fund and having somewhat of a trader mindset, something that we tend to do better is like very quickly flipping when the facts change. Whereas I think for a lot of other sort of funds, it takes a while for to go from a really negative thesis to a really positive thesis. They can't just do that in the span of 5 minutes. But I think what we really identified is, first of all, I have a longer term thesis that the crypto space in general is really sort of desperate for an app layer token that has a real moat, generates real revenue, and really returns that revenue to holders. Like, I don't think there's a lot of examples of that. And you see this with GMX. Like, GMX has a lot of flaws, but because they do those three things well, the token is extremely successful, right? The market is just has an extremely large appetite for that. And so we're always sort of watching for something that can fill that boat. And the moment that these three things inflected on dYdX, given our strong sort of view on the fundamentals, we sort of formed the thesis that, this project may actually become that. This may actually become that trade, that very like stereotypical app layer token that really generates money, really has a moat, and really returns that money to holders. And
I think it's important too that there's actually a fourth inflection point there too, which is that decentralized derivatives as a percentage of overall derivatives trading is still only like 1 to 2%. Whereas if you look at like Uniswap's market share of spot trading, decentralized spot trading is 10 to 15%, depending on the month, of overall spot trading. And that's up, by the way, from about 1% 2 years ago. So if you think that decentralized derivatives are about 1 to 2 years behind decentralized spot, there is a path where this industry itself is meaningfully takes market share. The sub-industry of decentralized derivatives meaningfully takes market share from the centralized exchanges. And you had a big catalyst in the fact that one of the largest centralized futures exchanges, FTX, went away.
Right.
I think you do have a secular kind of trend there as well. And I'd point out, when we put the thread out, I don't want to use the word bashing, but putting constructive criticism out there on dYdX and with regard to their lack of transparency and the lack of tokenomics. Again, a lot of people rush towards thinking that we're negative on it. And in fact, we're not. Part of what we believe is important in this space is calling out, bad actors or even good actors who make mistakes and really trying to be a catalyst for change and positive change, right? Some people would look at all the negatives that we pointed out and say, oh, they must be short, they hate it. I look at the negatives we put out as these are things that if they fix, this is a home run. And I want to put a little pressure on them to fix them because these are easy fixes that in some ways were, either just a lack of external pressure on their end or outright negligence. And I don't think it was the latter. I think it was just a lack of external pressure allowing them to kind of get away with this. So, we put that out there. And one of the pieces of feedback we got a lot was, well, this is just broken to begin with because you have a company that issued a token, right? The fact that there is both equity and token holders in the same structure, in the same capital structure, means that there can't be proper value to going to both. And I would argue that that's just not true, right? I mean, Binance is the spitting example of how to do both, right? Binance has a $250 billion enterprise value between the value of their private equity as well as the value of the token. And it's because they realized early on that, hey, we can issue the BNB token and we can say, okay, we're going to give you a piece of the economic upside in the business by taking a percentage of revenues and burning tokens. So right there, you have a quasi stock-like instrument. But we're also going to make the BNB token super useful with utility value by giving you rewards or giving you, the ability to get fee reductions if you trade on our platform and to use our token as collateral once to post for futures and options. And as a result, like there is an equilibrium where you can add to the overall pie, even if you're taking a little bit away from the equity holders to give to token holders or vice versa. So again, our criticism of dYdX was not, oh, this thing is, going to zero. It was, you have fixable problems. Now let's stop, jerking around and let's go fix these problems. And I think, one of the other things that you mentioned of the four catalysts, one of them is sort of a deeper topic in my opinion. And I'd be curious your opinion on this, which is that unlocks in general, my opinion is generally when you mess with supply side instead of demand side, you're just kicking the can down the road, right? Ultimately, to do things right, you really need to increase the demand side of the equation, right? You need to create demand for somebody willing to buy this instrument for you. The supply side is going to be there either way. So if you just so if you put an unlock schedule in there, what you're effectively saying is, hey, VCs, hey, early employees, we're going to give you these tokens at some artificial discount. And at some predefined point in the future, we're going to let you sell them. But there's going to be no merit based. It's not going to be like, we don't have to hit any targets. We don't have to hit any KPIs. We're just going to get to a point where you get to sell it. And what that does, in my opinion, is that it creates perverse incentives, right? It's not like the equity market where your stock unlocks when they go public. And in order to go public, you have to meet some sort of threshold, right? You have to do something in order to become a publicly traded company, in order to have the ability to pay the registration fee in order to meet certain requirements of the SEC. Here, you can issue a private token and then 2 days later issue a public token if you want. And what you're doing is you're just basically creating this unnecessary expectations of sell pressure instead of doing what you should be doing, which is trying to convince people to buy it. And I argue that we should just get rid of unlocks altogether. If you want to issue private tokens to VCs and give them to your employees, that's fine. But let them be tradable right away. Let people who don't believe in what you're doing sell them to people who do, and let free markets take over, versus creating these artificial cliffs that essentially just give these early investors free money for doing nothing other than being early. So I'm curious your opinion on that.
Yeah, no, I mean, I generally agree with you. Like the entire sort of structural system of raising capital in this space and doing it in this way where you get these large cliffs, I think is flawed. I do think it's one of those cases where like the things are imperfect, and just because it's flawed, it doesn't mean that it's necessarily wrong, because it's hard to come up with something better. And so it's hard. Like, I don't have a perfect answer for how that process should be run, but I do agree, like, the current system has a lot of perverse incentives and creates a lot of issues. And I do also agree that, kicking the can on the unlock doesn't actually change anything fundamentally. However, what it does do, I think, is push that unlock to a point where, to your point, the demand drivers will hopefully be stronger, right? Like, if you push that unlock to once V4 has been activated and that revenue is actually flowing to holders, then there is a lot more natural demand of that unlock. And also probably a lot of those people that are unlocking may not want to sell. And so I think actually it's a huge vote of confidence from the team that they're willing to extend it, because it shows that they do have confidence in V4 launching by then, right? Which is ultimately what's most important. And I think one other point that just to finish the sort of discussion on the thesis, that some people push back and say, well, they're never going to return the cash that they already generated. Well, first of all, we don't know that, but second of all, who cares, right? Like, these businesses are not valued on their balance sheet. Like any high growth business is not valued on the cash that they currently hold. All we care about is the ability to generate future earnings. And the thing that's so powerful with dYdX is that if they actually get this right, there's such a large opportunity to be such a big product. Like, the potential here is really sky high, especially on their own chain, where if you think about, especially in the early going, like I think the sort of early sort of thoughts on this, I don't have sort of any concrete knowledge, but my sense is that the vested tokens are not going to be stakeable. And so actually only the liquid float will be stakeable those first few months. And so the yield that you'll generate, if that's the case, will be like, $150 million of revenue on a $300 million token. It's going to be a 50% APY to just buy and stake dYdX. Like, that is a really, really powerful thing. And on top of this massive long-term potential of being the leading decentralized exchange, like, I think that sort of gets underappreciated and lost in the noise of all these other tokenomic discussions, is just how large the fundamental opportunity really is, and how much demand there is from fundamental funds to own something like that. So that, like, ultimately is what really attracted us to it. Like, yes, there's execution risk, and I don't know, but like, there's few things where you can say there's like legitimate fundamental 10x upside from current prices, and this is one of those things.
Yeah, and as you said earlier, I mean, there's only a handful of businesses in this entire space that have real product market fit, real revenues, and have a real ability to be kind of long-lasting. And this is one of them. And I think that's why it was so frustrating to us that, like, they had done everything right except for take care of their token holders. And to your point as well, like, I don't think they owe any of the money back that they earned prior to issuing the token. I think once you actually issue the token publicly, though, you do have a fiduciary responsibility to your token holders, right? Nobody forced them to issue a token. They chose to do it. And once you have a public token out there that people can buy, right? I know they're not forcing people to buy it, but if you list it on an exchange, or you have it, trading on, if you're providing liquidity to an AMM and it's available for people to buy, once there are token holders out there who have paid actual money to buy this, you do have a fiduciary responsibility or an ethical responsibility to do right by them, right? Either in the form of just being transparent, or in the form of providing some sort of value to that. And I think that's really where they erred. And honestly, this is not about dYdX themselves, and more just industry-wide. Like, if you have a token out there, you do have some responsibility to your token holders. And if you don't do it, don't be upset if somebody calls you out for it and starts to demand change, because that is the right of token holders as well. You don't need explicit rights to the cash flows to be a stakeholder in the business and have a voice. And I think that's my biggest takeaway for everybody in this space is, I don't care if you're, a large fund like, North Rock or Arca, or you're just a small individual, you have a voice. Call out if you don't think that these issuers are treating you fairly. And I think we can be a positive voice for change and start to effectuate some change. So with that said, I think agree that this is a good business. There are easy fixes to make. There's a really good long-term future here with V4. And hopefully dYdX Foundation and dYdX Trading is listening here, and they continue to take some of this to heart, which is, do right by your community, do right by your token holders, and you and everyone else around will be rewarded as well. So with that, I know we're pushing up against time here. Anything else, Hal, you want people to know how to find you, or any other topics you think are interesting as a sort of a parting shot here?
No, I mean, that kind of wraps it up. I do just to close the loop, think everything you've been doing is helpful. And really, like, this is one of those cases where the path is clearly laid out in front of them, and they just really need to take it and execute on it. It's not like rocket science. I think from here, they just need to execute on a clearly deliverable path. But if they do, there's tremendous upside. And so I certainly commend you for really pushing to realize that potential. Where to find me? At NorthRock LP on Twitter, northrockdigital.com. Either of those work. And look forward to seeing what happens here.
Well, great. Well, I'll echo that. I think it's very hard to build a really good business or a protocol and have product market fit, but it's really easy to take care of your stakeholders. So with that, Hal, thank you for joining us today. Obviously, we'll have you back. For those listening, thanks again. You can read the blog on our website at ar.ca/blog. You can watch this every Tuesday, and we'll be back again next week. Thanks for joining, Hal. Thanks, everybody.
Thanks so much for having me. I really appreciate it. Have a good one, everyone.